Okay, we're going to get started. Good afternoon. My name is Connie Comiker. I'm the Director of Marketing here at Roth&Co. Thank you for joining us today. Welcome. I have with me Shalom Rosenbaum, CPA and Accredited Business Valuator by the AICPA. Shalom is a manager at our Advisory Services Department. He will be presenting today on estate planning, specifically on how it's affected by COVID-19, political uncertainty, and the recent lifetime exemption changes. I know you'll find it interesting and informative. I will be moderating your questions on the back end. Feel free to use the Q&A function on the bottom of the screen, and we will get to as many questions as possible at the end of this webinar as time allows. If we don't get to your question, don't worry. We are going to send a follow-up email answering as many questions as possible. So again, welcome, enjoy, and I'm going to pass you over to Shalom.
Thank you, Connie, and thank you everyone for joining us today to discuss estate tax planning and why it's extremely important now as we have what I call a perfect storm for estate tax planning. We have a time where we have COVID, political uncertainty, and potential changes to the lifetime exemption, which is monumental and significant, and I should say unprecedented in history of estate tax planning in the United States. Every now and then we always have changes. You know, each political party looks at estate tax from a different perspective. Republicans call it the death tax. The Democrats believe that this is a perfect way of distributing wealth and reduce income inequality. And it becomes a little bit of a political football every now and then. But now, because of COVID, and because of potential changes in the, obviously, on the executive level, as well as the legislative branch of government, those potential changes may impact your either existing estate tax plan or should encourage you and push you to do estate tax planning for the future. Estate tax planning is something that we all procrastinate and delay. After all, who wants to think about death? Who wants to plan what we're going to be doing after our demise? And sometimes we need that event. Sometimes we need this perfect storm to encourage us and to push us to act. And I think this opportunity is presented to us at a time that will allow us to reach out to our advisors and to figure out what we can do to plan the estate tax portion of our estate, which is obviously one of many components of estate planning. And once we do estate tax planning, we can look at the bigger picture as well. The concept of estate tax is something that is very complicated. And I know that we have a range of audience today. We have professionals advising their clients, and we have individuals who are interested in learning a little bit more about how estate tax can impact and affect their estate. And that's why we're going to try to start with the basics. We'll have a review of the concept of estate tax, and we're going to get a little bit more into why estate planning is important now and how we can use the valuation, the political uncertainty, and all the other parts of COVID-19 and lifetime exemption portions of estate tax planning to plan our estate tax. The purpose of an estate tax was to tax the transfers of wealth from one generation to another. Obviously, the real reason is that the federal government needs to support its operations, and this serves as a tax revenue to the federal government. But as we said, the purpose is also to ensure that there's, that we minimize income inequality and to spread the wealth among the nation. We don't want to have wealth concentrated with the Vanderbilts and the Rockefellers. And as a result, the federal government introduced the estate tax, which is technically a unified tax. It's a tax on the transfer of wealth, which is levied both on an estate when someone passes away, as well as on the donor of a gift when a gift is given to the next generation. So an estate tax is something that is obviously levied upon death, but if you precede that by giving a gift during your lifetime, you will be subject to this tax as well. And the purpose obviously was so that people shouldn't transfer all of their assets during their lifetime and not have any tax at death because they no longer own any of those assets. Now, this tax is not levied on the recipient. Someone who receives an inheritance, an heir who receives an inheritance, a recipient of a gift, is not subject in the United States to any tax other than income tax for the future income of this asset. But upon receipt of an asset, the recipient is not subject to any tax. The decedent or the donor of this gift has to pay a tax either from the estate or at the time of the gift. Congress understood that it is normal and usual for people to transfer some portions of their wealth to the next generation, and they understood that they shouldn't penalize people for earning or amassing some wealth because, let's face it, those people already paid income tax on those assets, and an estate tax effectively is a double tax on the earnings of an individual. And that's why Congress over time allowed people to either use what we call a lifetime exemption or an annual exclusion to enable one to gift or to share some of his or her assets with the next generation. And the way Congress structured this exemption is that a person has a tax credit on the estate of this individual, meaning when someone passes away, there's a calculation of how much tax he or she now must pay on his or her gross estate. That tax gets reduced by a credit which is equal to an exemption amount of $11.58 million per individual. That means that for the first $11.5 million that you own, you won't have to pay any taxes at this point in time at the point of death. Now, if you give gifts throughout your lifetime, this amount gets reduced. And so if you gift $11.58 million today, you won't have anything left at the time of death. There are some inflation measures that increases this over time, but overall you won't have any exemption amount available upon death. And at that point in time, you'll have to pay estate tax. So the gift tax and estate tax work together, and we look at the 11.58 exemption as one whole exemption for both gift and estate taxes. Once you use this up, you have to start paying tax. Now, this amount is indexed for inflation, as I alluded to before, and in 2021, it is expected to be $11.7 million. This amount was doubled under the Tax Cuts and Jobs Act, and we'll see soon, may be reversed either sooner than the sunset provision or by 2026. In addition to the exemption amount, people can give away up to $15,000 each year to each individual, whether it's their children, descendants, or other people, up to $15,000 a year tax-free. This is known as the annual gift exclusion amount. And this, again, serves a purpose so that when people give gifts, small gifts, give a holiday gift to your son, daughter, or other people, it's not subject to tax on the recipient, but also the donor does not have to pay tax on that amount. Congress also understood that sometimes assets are owned by either husband and wife. And therefore, Congress introduced this tax as a way that it is taxed on an individual level, meaning each individual has their estate or gift tax, but this tax can be split between husband and wife, so that if a husband owns all of the assets in his name, or a wife has all of the assets in her name, each one can give the gift to their children, and it would be considered as if both gave half of the gift. And that's why the exclusion or exemption amount can be shared equally by husband and wife. Now, why is evaluation important as it relates to estates and gifts? The estate tax and the gift tax are both levied on the fair market value as of the date of the gift or as of the date of death. Fair market value is something that much ink was spilled on. There are many different revenue rulings from the IRS. The IRS explained what fair market value is, but the bottom line is that fair market value is considered to be a hypothetical transaction between a willing buyer and a willing seller. And they have to know, obviously, all of the facts related to this business. And that includes a couple of factors that the IRS outlines in Revenue Ruling 5960. Those factors include, you look at the nature and history of the business. You see the trends of this business, the risks of this particular business. You see whether or not this business has a viable future. As part of the analysis, you look at the economic outlook and the industry conditions, because the economy as a whole, whether it's on a global level or on a macroeconomic level or on a microeconomic level, it may impact this business operations. Tariffs may impact the business. Government shutdowns may impact the business, both in the short term and in the long run. And that's why those have to be taken into consideration when you value a business. The industry conditions, whether an industry will be successful. Think about the hospitality business at this point in time, and you can compare that maybe with the healthcare industry. Different industries have different valuation techniques because they have different factors as to what will contribute to their growth and their future. You must look at the financial condition of the business, the balance sheet, see if this business is liquid, is solvent, see what the capital structure of this business is. Is it over leveraged? And in times of economic recession, it may be at risk, or is it on solid footing? You can see the book value of the business, specifically the equity of the business, to see what contributions this business required from its owners and what restrictions there are on any potential distributions. Obviously, a business is only worth as much as it can earn and pay out as dividends to its owners. So you have to analyze the income statement, see what it earned and see what it could earn and what the owners can take out of that business. The additional factors that the IRS outlines is any value of any goodwill. Most businesses don't have much assets. A lot of what is worth of the business is the goodwill that they have or intangible assets, their trademarks, their brand, their reputation. And this usually can be looked at as generating future income for this business. Now, there are discounts that we take into consideration when we value business, and I find that many professionals think that this is the area where you can reduce the value of a business, and the IRS knows that. And the IRS looks for aggressive valuations where discounts are either unsupported or too aggressive. And then part of what you have to look at in evaluation is any comparable sales to this company, which can include either the company's historic sales if they admitted partners or shareholders in the past, as well as comparable companies in the public markets. These are the factors that the IRS outlines on how to value a business. If we can summarize these factors and say, what is important to us as business valuators? How do we at Roth&Co address evaluation and look at evaluation? We can say that it depends on the following components. It depends on historical revenues and profits. If a business generated revenues and profits in the past, we can expect that that will continue in the future. Obviously, we don't value a company as to what it did historically. We don't look at history. Valuation is not a history lesson of a company. Rather, we look at the future. No market participant would buy a company because it was good in the past. No one would buy Kodak or Blockbuster because it was a good company in the 80s and 90s. People look to the future. People want to buy a company that is expected to do well in the future, and that's how we value a company. But sometimes historical revenues and profits serve as a benchmark and serve as an indicator to tell us how this business will do in the future. And that's why we want to look at projected revenues and profits. Sometimes this is something that management can put together based on either forecasts or based on market information. Sometimes it is based on the past and historical revenues and profits. But these projected revenues play a big role in evaluation. And how do we project the future? How do we look at all that? We look at what the economy would provide for this particular business. Is this a business that is essential? Or is this a business that may be at risk if there's an economic downturn? Is this business competitive within the industry? Is the industry in general as a whole something that may be disrupted by another big force, or is it expected to continue on in the future? So those projections are extremely important because the more revenue or profit a company is expected to generate in the future, the more valuable that business is. But a business is only valuable if it has no risk or minimal amount of risk. If a business is extremely risky, you can compare two companies that have the same projected revenues and profits, but one may be shut down tomorrow, while the other one may continue as a going concern into the future. And the business that has a lower risk will obviously be worth more than the business that is at a high risk. And that's why we have to look at the business risks. Now, the business risks involve obviously the economic risks and industry risks, but on a business level, what is the risk that this business may not be able to continue, may not be able to actually see its projected revenues and profits come to fruition? They may not be able to effectuate their business plan properly because there is some type of risk that is outstanding. Another thing we have to look at are the working capital and capital expenditure requirements for this particular business. Sometimes a business may be profitable. Sometimes a business has the capacity to generate revenues that will continue to persist in the future, but they need much working capital. That means they need a lot of investment in cash, receivables, inventory, or other assets that wouldn't allow this to be cash flow positive, or maybe wouldn't allow this business to generate that much cash so that it should be able to pay out dividends to its shareholders or partners. And as a result, sometimes even if a business is successful, even if they have good projections, if the investment in either working capital or capital expenditures, that is fixed assets, is prohibitive, that may present a risk to this company and decrease the future cash flows and reduce the valuation for this company. Now, one area which I think is underutilized sometimes in valuations is the timing of the benefit stream. Think about a technology company that is expected to be worth billions of dollars in the future. Obviously, Silicon Valley has a way of valuing companies that doesn't need either a spreadsheet or a calculation. They determine that on their own. But if we look at a valuation of a technology company that is expected to incur lots of losses over the next couple of years, or is not expected to generate a lot of cash income, because of the time value of money, because a dollar is worth more today than in the future, the timing of these cash flows, the timing of the profit of the company is extremely important in a business valuation. And except if this company can be sold at an exit for billions of dollars, if the future cash flows are much smaller in the next couple of years, in the near future, rather than down the road, this valuation is worth, or this valuation of this company is less, and this company is worth less than had it been able to generate cash flows in the near future. And that's why when we look at a valuation, we look at what cash flows can this company generate within the next couple of years. And if that is low, the valuation may be a very low valuation. So where does that all come in to estate tax planning? One of the methods and the planning tools that we can use to do proper estate tax planning is to either gift or sell assets during a person's lifetime. Now, why is that good? If we have $11.5 million available to transfer tax-free, what difference does it make if we do that today or if we do that at the time of death? The answer is that we expect our businesses or assets to appreciate and go up in value. And if we have an asset that is worth much less today than it will be worth in the future, if we gift it or transfer it out today to either a trust or to our children outright, and that is no longer included in our estate, upon death, we're not taxed on that amount. And so if a business is worth $1 million today, but it may be worth $11.5 million in the future, if we gift it or transfer it when it's worth $1 million, we can now have an additional $14.5 million available in gifts or estate value, tax-free. That is the purpose of estate tax planning. Now, obviously, for that reason, you want to transfer the assets when the value is low. You want to transfer the assets that have growth potential, that will grow outside of the estate, outside of your assets, because like that, you're not going to have to pay taxes on that in the future. Now, obviously, because of that, assets should be transferred when the valuation is low, which is a good opportunity at this point, as we'll discuss soon. And assets should also be transferred, especially if you sell the assets when the interest rates are low. So let's discuss selling assets for a minute. Why would an individual sell the assets to the children or to a trust instead of gifting? One reason why you want to sell the assets instead of a gift is, first of all, when you sell an asset, you're not using up the exclusion amount. Now, sometimes it's good practice to seed your trust with a down payment so that the trust can buy the assets, and it would seem reasonable for a trust to buy an asset, and that you should actually sell the assets to the trust, because in a bona fide arm's length transaction, you wouldn't sell an asset to an individual who cannot pay some type of down payment. And the remaining amount may be structured in the form of a loan. So you're selling the asset in exchange for a promissory note where the trust will pay you over time for that asset. If the interest rates are low, that enables you to not only sell the asset at a low valuation, which requires a very low down payment, but also it allows you to have a very, very small promissory note, and allows the trust to have very, very small payments to you. Now, the purpose of selling an asset is that that doesn't use up your exclusion amount, and you can transfer much more over your lifetime than what the exclusion amount provides for, number one, or the lifetime exemption provides for. And number two is that you can sell this to your children and still get a benefit stream or an income stream to support your livelihood. Sometimes in estate planning, people transfer out all of their assets, and now they're not left with any assets to support their lifestyle. And you want to maintain some type of asset, some benefit stream, some type of income so that you can continue living and paying your bills. And you can transfer out a certain amount of assets in the form of sale and get some of that interest payments to support your lifestyle. If you would transfer out all of your assets and then receive some of the assets back into your estate in a way that may undermine your estate tax planning, the federal government may see that and say that the estate tax planning was not effective, and really all of those assets are included in your estate. And that's why you don't want to commingle funds between your estate and assets that are outside of your estate. Bottom line is, if you have a lifetime exemption, you want to use it up so long that it is available. And this $11.58 million is indexed for inflation. But in 2026, under the current law, this will go back to what it was prior to the Tax Cuts and Jobs Act, which was $5 million and indexed for inflation. Now, the good thing is that last year, the Treasury Department said that they won't claw back any gifts or transfers that were made during this period of time, during 2018 through 2025, which means if you used up all of your lifetime exemption amounts, okay, they won't come back and say, we're going to take some of that back. For example, if you gifted an asset that is worth $15 million, when this provision sunsets, they're not going to come back and tax you for the amount above the future exemption amount. That's the first thing. The second thing is, if any future administration reduces this lifetime exemption amount, whatever you gifted, whatever you transferred, you already used, and they cannot tax you on that amount. This is basically an instance of either you use it or you lose it. And that's why this presents a unique opportunity to take advantage of estate tax plan. So let's look at COVID, and let's see how COVID impacts those factors we discussed before and reduces your business's valuation. We all know there were government shutdowns, there were a lot of restrictions, and that impacted many businesses. Smaller businesses struggled as they were closed. Larger businesses may have had various disruptions, either in the supply chain or maybe even in visiting customers. Maybe they were located in certain cities that now have a decrease in population or employees, and that's why their business was hurt. Now, we don't know what's going to happen in the future, but the shutdowns, the restrictions may continue, may go on, and that will impact your projected revenues and projected profits, which will bring down the value of your business. We don't know what's going to happen with the vaccine. We know that as of this point, it seems like 2 companies have vaccines that may be very viable, but we don't know how that's going to happen and how the storage will work out and how the distribution will work out and what's going to happen when the vaccines are actually administered. And that's why this presents an economic risk, potential recessions. It continues to represent that risk to individual industries and specific businesses. And obviously some businesses may be obsolete or may be threatened because of the change in business models. If you have real estate in Manhattan, what happens about all of those people that started working remotely and may continue to work remotely, and the real estate won't be as valuable in the future. And that obviously impacts all of the businesses in such cities. So COVID may have decreased the value of your business. If you can say that your projected revenues may be lower, if your operating expenses may be higher because of increased PPE, because of more office space that you need because of social distancing, and if you have a risk for your business because there's uncertainty about the future of your business, that will reduce the value of your business. Now, even if your business recovered and got back to pre-COVID levels, if you can say that the projections may be impacted by the risk, we'll have the projections at pre-COVID levels, but the risk will definitely be higher. And if your projections are sort of back to what it was 2-3 years ago, well, will it take a couple of years for you to recover? If your levels are very low today, your timing, your benefit stream today is much lower and maybe lower in the next couple of years, which will again reduce the value of your business because the benefit stream of this business is lower in the near future. All of this reduces the value of your company. And that is why it presents us with a unique opportunity to get a low valuation for either gifts or sales of your assets to trusts or to other types of entities or individuals outside of your estate. Political uncertainty. It seems like Joe Biden is our president-elect and will be our next president. But is there a risk? Is there volatility if Trump continues to contest the election and maybe can use unconventional methods to continue being the president? Will the Democrats control the executive and legislative branches of government? All eyes are on Georgia. We want to see what's going to happen. Will the Democrats control the Senate, or will the Republicans retain their control of the Senate? And that may be important and significant for our estate tax planning. What will be the future of the lifetime exemption? Will that be decreased significantly, or will that stay the same? Who will control the narrative of the Democratic Party? Will the progressive wing control the narrative? And they obviously want to tax the wealth of individuals. They want to decrease economic inequality. And what better way to tax the wealth than increasing either the estate tax or decreasing the lifetime exemption? I think that's an area where the politicians can find consensus, where it's not a wealth tax that gets imposed annually on individuals, such as many progressives have introduced and recommended. And even some Republicans, moderate Republicans, may understand that maybe the estate tax does not impact or hurt many of their constituents, and they may agree to maybe accelerate the sunset provision of the Tax Cuts and Jobs Act. And that's why we know one thing. We know that Joe Biden released the tax plan, and he wants to reduce the estate tax exemption back to $3.5 million per individual, which means if you have assets that are worth more than $7 million between you and your spouse, that means that in the future, you may be subject to estate tax. And you can move that out today and take advantage of this exemption so that you don't have to pay tax in the future. But even more than that, Joe Biden's tax plan wants to reduce the gift tax exemption to $1 million per individual, which will limit our ability to gift pre-death. So that means if we want to transfer during our lifetime, we only have the availability to do that up to $1 million or $2 million per couple. And so if you want to transfer by a gift, you want to do that today.
You cut out by the last part. You want to just repeat the last bullet point?
Okay. So again, Joe Biden's tax plan will reduce the estate tax exemption so that it will become $3.5 million per individual, which means if you have an asset that exceeds $3.5 million or cumulatively with your spouse's assets exceeds $7 million, you may be subject to estate tax upon your death. Now, one of the benefits of estate tax planning is that we can transfer those assets during our lifetime by the means of a gift. Joe Biden's tax plan wants to reduce the gift tax exemption, which now is aligned with the estate tax exemption, and it is the same. He wants to reduce that to $1 million per individual, which means if you want to transfer assets during your lifetime, you're only going to be able to do that up to $1 million or $2 million collectively with your spouse. And as a result, it's going to remove much of the opportunity we have today to do proper estate tax planning. Not only that, the tax rate may go up based on this plan from 40% to 45%. And one very important part of the tax plan eliminates the step-up in basis. What a step-up in basis means is that when someone passes away, their estate is expected to pay estate tax. But even if they don't pay an estate tax, the assets are inherited to the heirs of the estate at its fair market value, which means if the decedent purchased the property for $1 million during his or her lifetime, the property appreciated in value and is now worth $10 million. The children inherit an asset that has a value of $10 million. The estate wasn't taxed because it was below the exemption amount. The children now turn around and sell this asset for $10 million. Usually they would be subject to a capital gain tax for the difference of their basis, which is the amount they purchased the asset for, $1 million and $10 million. $9 million capital gain tax. Now, Joe Biden's tax plan wants to eliminate the step-up in basis and wants to say that you would be taxed on that $9 million. Part of the tax plan, by the way, also increases the capital tax rate ordinary above a certain level of income. And that too may increase the estate, not the direct estate tax, but the income tax to the heirs of an estate. And all of that, because we have this political uncertainty, and because we have all future estate tax exemption reductions which will either happen in 2026 when it sunsets, or we have to take advantage of that opportunity today and do proper tax planning.
We got a question about the slide. It's from JW, and he's asking, do gifts also get a step up in basis?
The answer is that gifts do not get a step up in basis. And the tax on gifts when they are sold depends on whether it's sold at a gain or a loss. And I think it's beyond the scope of today's webinar. But the short answer is that it does not get a step up in basis.
Thank you.
I'll expand a little bit on the answer to that question. In the past, when we at Roth did estate tax planning, we always considered to leave some assets within the estate, or maybe swap assets in the future to the estate, so that when the individual passed away, so that he or she would have a certain amount of assets that would receive that step up in basis. With that step up in basis going away, it may change much of what we do in estate tax planning. It may tell us to use as much of the lifetime exemption as we can today, because that may be going away. So what do we have to do today? As we said, we have to maximize the lifetime exemption. We have it today. We don't know if we're going to have it tomorrow. So we have to take that before it's too late and sit down with the advisor, sit down with your attorney, your accountant, and come up with a proper estate tax plan so that we utilize as much of the lifetime exemption we can today and not be subject to estate tax in the future. And at the same time, we have a unique opportunity where business valuations are lower than it has been in quite some time. And those two factors together allows us to gift or sell businesses at a low valuation and save on estate tax planning, on estate taxes in a way that we couldn't save in the future. And obviously, once you discuss estate tax planning, you can take advantage and discuss your general estate planning to begin with, so that you can plan succession planning or probate or other things that may come up in your general estate plan. And I'll open it up for any questions, Connie.
That is all the questions for now. Does anybody else have anything they would like us to cover? And we're getting a question. The question is, it's from Todd, and he's asking, upon death, when you sold assets to a child or trust, would the loan value come back to the estate?
So the answer is, it depends on how you structure the loan. There are ways to have the loan outside of the estate, but I think that's a good question, and I'll answer it from a different perspective. If you transfer an asset by means of a sale outside of the estate, that sale consists now of a note. That note is a fixed value. That value does not increase over time. It does generate some interest income, but if you have a business that is expected to earn more than what the interest rates are today, the interest rates are very low. Even the long-term AFR rates are about 1%. So if you have a business that generates a return that is greater than 1%, the growth of this business will be outside of your estate. And this loan value will remain in your estate at a fixed value.
Thank you. We have another question from William, and he's asking again about the no step up on gifts. He wants to know if this is under an existing law.
Again, the existing law does not provide for a step up in basis under gifts. There are ways to calculate gains and losses when the recipient of a gift sells the asset. In short, it is a carryover basis from the original holder, which is the donor's basis carries over to the recipient. And when there's a sale, if it's sold above the base, above fair market value or below fair market value at a loss, would generate a certain tax calculation. Again, it depends on how much it is sold at a later point in time, but there's no step up in basis for any gift transfers.
Thank you. Our next question is, does a property that was contributed to a trust get a step up basis?
Good question. It depends on the trust. It depends if the trust is in the estate or outside of the estate. Now, a simple example, I should say, not a typical, but a simple example would be that there are trusts that are revocable and there are trusts that are irrevocable. If it's a revocable trust, that means that you have control, and it could be irrevocable and you can still maintain control. So that's why I'm giving an extreme example. But if it's a revocable trust, that means that even though it's in a trust, it's still in your estate. And yes, you would get the step up in basis, but you would also be taxed on that amount upon death. If it's an irrevocable trust and you don't have the controls on this asset, that would be outside of your estate. And because it would be outside of your estate, you would not get a step up in basis and you won't be taxed. But in short, if you're going to be taxed on it, you're going to get a step up in basis. If you won't be taxed, you won't get a step up in basis. Again, obviously, considering that the exemption amount won't be taxed.
Great. Our next question is from Maisy, and he is asking, can the clawback position change in a future administration?
It's a good question. I think the way it is today and the way the Treasury regulations, this is a regulation that the Treasury Department released and that sort of interprets the law, the existing law. Things can change if a court decides that that was not the intent of the law. And Congress can always decide to overturn it. But because the Treasury Department released it under the current law, the existing law is accepted by all authorities in estate tax planning that this would not be reversed and would not be clawed back. So hypothetically, yes, but it's very, very, very unlikely.
Okay. Here's another question asking for clarification. Does the gifting that we're suggesting, should it happen before December 31st or can it wait till next year?
Okay. Obviously, the earlier, the better. But you have to look at your business and your estate tax plan to see what's better for you, and you should discuss it with your advisor. Some businesses had a downturn in 2020, and maybe their business started going back up and started recovering to pre-COVID levels. And so in 2021, you might not have that benefit. You might want to transfer it now while there is still uncertainty. You know, if the vaccine comes out and the vaccine is extremely, viable and works, and COVID is something that is in the past, which we all hope for, then businesses will hopefully come back to normal and you won't get that reduced valuation. Same thing with, the exemption amount. If Joe Biden comes in, obviously he's not going to come in until January 20th. And he probably won't be able to get something passed by Congress on day one. And we'll see what's going to happen with Georgia in January. But if you gift it even toward the beginning of 2021, make sure that the gift actually was effectuated at the beginning of 2021 so that the IRS, upon audit, shouldn't decide that you did it really after any changes went into effect, if changes went into effect mid-year. And so distributions from that company or, in general, the activity of that company should appear that it was actually gifted and transferred before any changes in the tax code were made. And that's why I would suggest that you do it as soon as possible. But let's remember, even if you make a gift during 2020, even if you make a gift now, you can still do the valuation next year. And it's beyond the scope of this course, but you can even do a defined value gift. Discuss it with your advisor, which means you can even gift a certain value of your business instead of a certain percentage of ownership in the business.
Okay, we have another question from Jay. He's asking, my accountant mentioned something called an intentionally defective grantor trust. Besides that, it sounds crazy. Is it something you include in a larger estate plan?
Absolutely, absolutely. Obviously, the scope of this course doesn't allow us to go into a larger discussion of all facets of estate tax. As I started saying, estate tax is a very complicated and convoluted concept and complicated within the tax code. An intentionally defective granted trust is something that is very common. We use it as well at Roth&Co because it is a way to transfer assets and yet have the tax attributes go to the donor or the transferor of the assets. So that is definitely something that we utilize, and it is very common in estate planning.
Okay, and I think this will be our last question from Jack, and he's asking, can the $15,000 gift per year be given to children, grandchildren, and great-grandchildren?
As with everything in estate tax, this is also a complicated question. At this point, it could be given conceptually. There is something called GST, Generation Skipping Tax, which is also a complicated concept as part of estate tax. And that's why you should discuss this concept, this $15,000 annual exclusion amount with your advisor. The simple answer is yes, but there are certain GST provisions that you may have to take into consideration, which is a larger conversation.
Do you want to take one last question? I know I said that. Was that the last one? So this is from Albert, and he's asking, how does one handle partnership in a property LLC and gifting to the estates?
How does one handle a partnership?
Yes, in property LLC.
I'm not sure exactly what he means with this question.
Okay.
I'm assuming he's probably talking about that someone is a partner and he wants to gift his portion of the partnership to a trust. I would assume that that's what it is. You would have to assign your interest to a trust. Maybe he's talking about, if he can clarify what his question was. Is he talking about discounts, minority discounts?
He said yes to the last thing you asked.
Minority discounts?
Albert, you want to clarify your question? He says no, he's good. Okay, so thank you very much, Shalom. For those of you asking, this is being recorded and we will send it out to all of you. If you would like to get the slides, a few people asked, sure, we're happy to share them with you. Email marketing@rothcocpa.com. Again, marketing@rothcocpa.com, and we'll send you the slides. There are several more questions that seem much more complicated, and I don't know if they apply to our whole audience. We will, Shulam and I will review them and then possibly send an email recap answering more of these questions. Thank you, Shulam, so much. This was really informative and interesting. Thank you, everyone, for joining us. We're so happy you were here. And again, look out for an email recap. We will send out the recording and possibly more information. Have a great day.